Hey, Adam Hoeksema here from ProjectionHub, and in this video, I'm going to be talking about how to calculate net working capital that you're going to need if you are looking to acquire a seasonal business. Now, I've talked in general at a high level in some other videos about how to calculate net working capital, so I'm not going to dive into the specific details of that here. What I really want to do is highlight some of the extra complexity of working capital when it comes to acquiring a seasonal business. And I'm going to do that by showing you a set of projections that we were working on for a very seasonal business in terms of cash flow, and then just give you some examples of what you need to be careful with when negotiating with a seller to make sure you don't end up screwed when you acquire the business and don't have enough working capital to survive. So in this particular example, we were looking at a campground. So this was a campground, and the way this model worked is it was mostly seasonal campers. So it wasn't like every couple of days you had new customers. It was more like they rented their site for the entire season. So from April through October timeframe. And it was, just one customer, and they would honestly pay mostly up front. And a lot of them would pay in March and April for the full year. And then some would actually pay at the end of the year to reserve their spot for the following year. So this got really confusing because this particular client was looking to acquire the business in January. And honestly, a lot of customers had already paid for their dues for the year. They had already paid for 2026 in this case, way back in 2025. So the question is, should the seller leave that cash for the buyer to be able to operate through the year? Because that's really 2026's revenue. But what gets real confusing is, yeah, but this is kind of how we always operate. And they're filing tax returns based on a cash basis. And, in 2026, they're going to be receiving 2027 revenue, earned revenue in, August and September, with people prepaying for the year ahead. And so, what is actually needed in terms of cash? So ultimately what we did in this case is the buyer they were well aware that a lot of that cash had already been paid, and they were able to come with enough working capital of their own to be able to weather that storm, and knowing that they were going to get an influx of cash in March and April, and then they were going to get paid for the next year at the end of 2026. So they basically said, hey, we're just going to not worry about the complexity of all of this and try to figure out which customers had prepaid and which hadn't, doing some sort of rebate, or what happens if the acquisition date gets pushed back, and maybe we don't close until March. Well, then what happens in March if you've got, some customers that have already paid for this year and some haven't? Like, you could get a lot of complexity here in your agreement. And in this case, the buyer said, I'm just bringing plenty of working capital. I'm just going to bring a lot. I'm going to bring like a whole year's worth of expenses into the deal. In this case, they had relatively low expenses. It's a campground, relatively low operating expenses. So they just brought a lot of extra working capital, and then they simplified the deal with the seller and just said, whatever cash you collect early is yours. And then, we'll just take whatever we collect after is ours. And there's some risks with that, because if you have a dishonest seller, what if the seller starts to try and, maybe you haven't closed in January yet, and they're sending letters to their customers, hey, quick prepay, I'll give you a discount, prepay me for the year. And so you've got to be really careful about that type of thing. I think this was a unique case where the buyer and the seller knew each other. Maybe that's okay. There was some trust built in there. But I think if in most cases, you really need to get this in writing and clear detail. And the problem is that it's a moving target. You can't really decide on this is how much working capital is going to be need to be left in the business by the seller, because at any given point, that could change. If you think about a seasonal business that is retail around Christmas time, maybe they make 40% of their revenue in the last 2 months of the year. You're trying to close in the fall before that happens. You end up not closing until after the busy season. What do you do with that? That seller gets a whole extra year of all the benefit of the busy season. Now you're waiting almost a whole year as the buyer for the next busy season, right? And so I think you really need to get a framework in place, an agreement and a framework, and understand the seasonality. Don't just look at the annual financial statements or the annual tax returns. If there's any seasonality in the business that you're acquiring, you need to get it broken down in terms of revenue per month of what is typical and what's expected. And then you need to hit that early with the seller. How are we going to agree upon this? And there's conflicts, right? If the seller feels like you're going to get this money anyway in these last few months, what's my incentive to keep selling or keep pushing to the finish line if you're going to end up getting to keep the accounts receivable that I sold? But if you don't do it that way, then the business is running out of cash at the end of the year. So it is really complex, I think. And I don't think, I haven't seen like this is the way you have to do it or the way that it's always done. And even if there is a way that is normal or standard, it doesn't mean that the seller is going to agree to that, right? The seller may have thought, I'm going to get anything I collect, I'm going to get to keep, right? That's what they thought. They had that in mind when they were negotiating. They assumed that. And so then if you come back and say, nope, you got to leave that extra $100,000 that you sold pre-sold, you got to leave that for me, that could be a shock. So you need to have these conversations early, make sure you're on the same page about it. And I think it's worth getting an accountant, getting a financial person in there to look at the numbers, try to analyze how much is actually should be needed, so you can visualize that in a financial model, and then get your attorneys involved as well to be able to get it in writing. So you've got the financial model that says this is what we need, and then you have the attorneys say this is how we're going to calculate it and what we're agreeing upon from a language perspective. So I think that's the approach. There's not a one-size-fits-all answer here. So yeah, just make sure to approach this carefully though. And if you have any questions, feel free to reach out to support@ProjectionHub.com. I like looking at these kinds of problems. We've been working on a landscape acquisition, which is very seasonal, this campground acquisition, a wedding venue acquisition that's really seasonal. So I've seen quite a few of these here in the last month really, and getting a better sense of kind of what are the things to be looking out for and what you need to try to focus on negotiating with the seller. So I'd be happy to take a look at that for you. All right, thanks.